terms of the holdings in your fund, you've got a majority of mortgage-backed securities. So now that we know the Fed is cutting back on its own purchase of MBS, do you shift your holdings at all? How does what the Fed is doing affect what you're doing in your portfolio?
Actually, the Fed's been buying mostly 30-year securities, and our holdings have been primarily in 15-year collateral. And the reason for that is you have better extension risk protection and prepayment risk protection, much more certainty of cash flows. So that's not been where the Fed's been playing, and it will not be negatively impacted by the Fed tapering.
So you hold the line, or will you add to that position?
Well, if things cheapen up, we will add. I mean, if you look at all risk premiums, so asset prices are at all-time record highs, whether you look at stocks. Interest rates, while low, went up last year, and risk premiums, whether you're looking at corporate bonds, mortgage-backed securities, agency securities, high yield, leverage loans, they're all relatively tight on a historical basis. So to the extent that you do get any backup in valuations, we would be looking to add at the right time.
And how about treasuries? You've got about 21% of your holdings in treasuries. Are you less pessimistic than about government debt? Where is it on the curve that you find opportunity, especially in light of the fact that we are seeing a changing environment?
Yeah, our exposure has been primarily in the 10-year sector and within the corporate bond sector out a little bit longer than that. We think that as corporate defined benefit plans start to approach being fully funded, the amazing thing about the rise in rates last year and the rally in stocks is that corporate pension plans went from being about 75% funded to about 93% funded. So interestingly enough, once they approach 100%, we think that pension plans will de-risk and actually be gravitating towards more high quality fixed income assets.
On the corporate side of things, you do own a number of corporate debt: Verizon, Newmont Mining, Domino's, American Airlines. I'm naming just a few. There's a lot in there. Where are you in terms of corporate and high yield? High yield a better option?
Our exposure right now is in the leveraged loan sector. So we favor leveraged loans over high yield bonds, and that's strictly a valuation call. Mm-hmm. If you look at where risk premiums are historically in leveraged loans, they're still relatively cheap, whereas if you look at high yield bond spreads, they're about a standard deviation and a half rich. So we would favor loans over bonds just from a valuation perspective.